Good morning, everyone. I'm T3 Live Editor-in-Chief John Darcy.
And I'm Brittany Umar, and together we bring you Morning Call. So futures are slightly lower this morning after the S&P ended at a new all-time closing high on Monday. Now, do you think this is just a pause, Darcy, or do you think we're going to keep going higher?
Well, I think, first of all, this is back to sort of the 2013 normal for this market, where we have a low volume sort of melt up, lower volatility. And I think this is what bears have grown to love and love to see in this market right now, is that we had a nice 50-day bounce off the 50-day moving average last week. And then on Thursday and Friday, we got really healthy rest, which is always something that bulls like to see. And then, like you said, yesterday was a very one-sided affair. We ground higher for most of the day and all-time closing highs. And now all that's in the way of this market in terms of resistance is the all-time intraday high around 1597. So we're down to flat to slightly down this morning. So nothing really to throw us off course, and it'll be interesting to see whether we can get that extension now to all-time intraday highs.
Right, so if you show us a visual of the S&P, show us what levels you'll be watching.
We'll take a look at the spiders here, and as you can see, we are above the 8 and 21-day moving average, obviously above the 50-day after we bounced off of it, and all that's in the way is that resistance previous highs. So, you know, not much to stop this market, stop this freight train of a market, and in general, I think you have to lean to the long side, despite the fact that, you know, a lot of charts are extended out there. A lot of sectors do look extended. You have to continue to try to find where money is rotating and maybe balance your book strategically at certain points with a couple shorts. But I think in general, you can't fight this trend right now.
And we do have a lot going on this week. It is expected that the Fed will maintain its monetary policy at the end of its two-day meeting, which does start today. But pressure is mounting on the European Central Bank to lower interest rates, and we'll find out if they do on Thursday.
You know, it certainly hasn't been economic data that's been driving this rally. You've had a really weak jobs report last month and even worse job prospects for this month, and then you had a GDP reading last week that was extremely light, and even worse, some of the numbers within that GDP reading were worse than the actual headline number, and then forecasts for GDP are especially bad. The sequester is starting to take effect and things like that. But I think central bank planning and all that type of stuff is what's really driving this rally. It's similar to the way it's been driving the rally over the last few years. You know, you've had very aggressive quantitative easing from the U.S. Fed that doesn't look like it's going to end anytime soon, but as they've tied most of their decisions to the dual mandate, and employment is one of their dual mandates, and as long as the employment picture is dismal the way it is now, with the lowest participation in the labor force since the 1970s, I don't think the Fed is going anywhere with QE. And then the European Central Bank, like we talked about, has a rate decision later this week, and noise is growing louder that they could elect to cut rates or introduce a more aggressive easing program. And then obviously Japan's easing program is very well publicized and very controversial, as you start to perhaps see currency wars heat up a little bit as people get upset with Japan for devaluing their currency.
Well, and as markets climb, there are stocks with high short interest that are squeezing or could get squeezed, and one of the primary examples of that is for solar.
Yeah, when you have an extended market, you got to look for some trades that have a little different mechanics that can potentially have some fuel to go higher. Because I think it's tough for people to pile into stocks that are really extended on the chart, really overbought. But I think when you have stocks with a heavy short interest, when they start to break key levels, it can really add fuel and add momentum to that move. And one of the first ones, Brittany, is electric car company that I've talked about often on Twitter and on morning calls and things like that, Tesla.
All right, so show us where we're getting squeezed with Tesla.
I didn't want to hog the spotlight there. I want to give Brittany a chance to talk. Nobody likes to see me. I can't really like to see Brittany. But Tesla is one that, like I said, I've been talking about very often on here, on these videos, and on Twitter, is one that has almost a 50% short interest. And if you zoom out to the macro on Tesla, you can see after the IPO, it had a nice channel over the next basically 2 years to digest. And it went higher in the first few months after the IPO, which is something that you like to see, unlike a Facebook that had a very unsuccessful IPO. But you like to see that nice channel, that nice wedge pattern. Then above that $40 level was really the place where you thought perhaps a short squeeze could happen, and you could get some more momentum to that move. And that's what we've seen. After we gapped above that $40 level, we got a retest of it, which was, you know, a beautiful place to enter if you weren't able to get in prior to this gap up. And just in general, the numbers in terms of earnings on Tesla are starting to catch up with the story, the electric car story, and the revolutionary thesis about Tesla. They have a very strong leadership group. Their CEO, Elon Musk, is one of the most respected CEOs in business. So this is one that, with these short squeezes, when you have such a high short interest, they can go a lot further, a lot faster than you even think. So even though this stock has gone, from $40 to $55 in April alone, I think if you do get a pullback into perhaps the 8-day moving average, just to give it a little rest and things like that, I think you could get some more upside in a stock like Tesla because of that huge short interest.
Now, are you expecting some more upside in a stock like Netflix, which has a high short ratio, but had two big gap ups on earnings and is holding above the recent earnings gap?
And Netflix is one that more recently it hasn't run after the latest earnings gap up. But if you take a look back at the previous earnings, you had a similar type pattern to what we're seeing right now. The last earnings, you had huge gap up after a much stronger report than people were expecting. It actually pushed higher off that earnings, but then put in a nice flag here that people are basically waiting for the next earnings report to confirm those extraordinary numbers that we saw in January. And we did see another strong report, and now it's above all of its short-term moving averages again, and putting in a nice upper-level flag. It's a little bit hard psychologically to chase a stock that's gone from $50 a share to $220 a share in about 6 to 8 months. But when you do see an upper level flag pattern in a stock that has a high short interest, I think you can't ignore it. You can't ignore the fact that it's perhaps a little bit extended. Maybe you wait for the 8 and 21-day moving averages to play catch up, but because of the mechanics of this trade, again, with the high short interest on Netflix, there's still a lot of people out there who haven't covered. And I think if you do get another acceleration out of this upper level flag, then you could get a nice short-term move. This is not one that perhaps I want to put in the drawer long term. Perhaps you could, because the company has really turned things around from a financial perspective, but I think for short-term traders looking for quick momentum type moves, these stocks with heavy short interest with upper level flag patterns are the ones that you want to trade.
Now, one that I find really interesting is JCPenney. Obviously, this company is no secret how much it's been struggling. It has a 37% short interest, but now we're getting reports that major hedge funds are buying into the company. Obviously, George Soros' stake and Goldman Sachs' big loan commitment. So
yeah, I mean, you have a lot of big players that are basically affirming their belief and commitment in this story. And JCPenney, obviously the numbers tell a very clear story that the company is dying, and if they continue at this rate, then they're going to go bankrupt. But they've changed their leadership back up. They're trying to get old customers back in the fold by going back to that coupon discounting model. And if you go to the chart of JCPenney, it's not one that I don't think is as slam dunk or as beautiful a setup as you see in stocks like Tesla, Netflix, FSLR, which we'll talk about in a second. But I think in general, as money continues to rotate, I think people are looking for patterns and stocks that potentially aren't extended to the upside and overbought. And JCPenney is certainly not extended to the upside. We take a look at the monthly chart on JCPenney. Back in 2007, it was a $90 stock. It's back at $17 a share. Bounced off this long-term support level that it came down to in the economic crisis. But it'll be very interesting to see whether the retail investor starts to pile in alongside those two big hedge funds that bought a nice interest in JCPenney, and then also George Soros. So I think this is one that does have some upside, and I think in a few months you'll see JCPenney back at least up into the $22, $23 level. This is a lower level pattern that I think you could play.
All right, well, let's jump back to First Solar then, because this is one of the primary examples of what we're talking about here.
Yeah, First Solar is one that obviously well-publicized move in April, like a 36% short interest, I believe. So obviously a lot of fuel. That's what I refer to short interest as fuel for these stocks because of the short covering that happens. And obviously you had this huge move on, they raised their guidance and they basically announced that they'd come out with a more efficient solar panel that could really revolutionize their business model. And so a huge move off of that. And then as traders, as one thing we teach in our swing trader course, our active trader course, is that use your Fibonacci levels and see how much of a big igniting bar a stock holds after it makes a big move like that. First Solar held the majority of that move, flagged nicely, and then broke above it and gave you an explosive trade. Now it's doing basically the same thing. It's somewhat like Netflix, is that psychologically it's a little bit hard. It was a $25 stock a couple months ago. You might be kicking yourself for not being involved from that level, but I think when you get an upper level flag pattern in a highly shorted stock like FSLR, it'll go further and it'll go faster than you realize. So I think if we do get a break above yesterday's high, that's your new point of reference, I do think you could get more upside in First Solar.
And just one more to get in. Cliffs Natural Resources had a nice short squeeze last week after reporting first quarter results on Wednesday, gained nearly 15% on Thursday. So think we'll get another round?
Yeah, I mean, Cliff Natural Resources is an interesting case because it's a coal mining company, or an iron ore mining company, excuse me, that is over-levered, in a commodity sector that is really struggling. They have hard assets of around $25–30 billion, but their market cap is significantly less than that because of the debt load that they have. But the most recent earnings report has triggered a little bit of a squeeze that I think could continue. As you saw, a nice little gap up. It's sort of similar to JCPenney, is that it's been absolutely decimated recently. This is one that I know people in the virtual trading floor have been talking about. It was a $100 stock, back in summer of 2011. It's all the way down here at $20. You go back to the daily chart on that. Like we said, we like to see a gap up and a flag, and that's basically what we're seeing in Cliff. So the 50-day moving average will be a big obstacle for it to overcome, but if it can get above that, with 25% or so short interest, it's another one that out of a lower level pattern I think can get some upside.
All right, well, coming up, we're going to be talking about banks that are flagging above support levels, but first a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches with banks that are flagging above support levels. And Citigroup is a great one to talk about because this held in the best of the banks during the recent sell-off. And now, will higher prices be in store?
Yeah, the banks are an interesting case because not only does the sector often show very clear relative strength or relative weakness to the market, but within the sector you have a lot of divergences. And every quarter after earnings, you sort of hit the reset button on the banks about which one's going to be the strongest and which one looks financially to be in the best position. And this time around, Citigroup had the best earnings. They easily topped expectations, and all the banks sort of reported during that weak period for the market a couple weeks ago when you had that erratic action. And Citigroup was the one that was able to shrug off the broader market weakness the best. If we go to the chart of Citigroup, like I said, it's become the relative strength play in the sector. It's above all of its moving averages, 821 50-day, coming there, curling up, supporting the stock. And you obviously have this pivot from early March to watch on Citigroup. And if you are playing the banks right now, I think Citi is one that you should look to and has some room to the upside. Now,
what about JP Morgan? Because JP also saw a nice rally that took it back above all key moving averages.
JP Morgan overall is one that's sort of been out of play. It definitely hasn't been showing relative strength within the sector. But obviously you can't ignore JP Morgan. It's obviously one of the biggest banks. And it is coming into sort of a mid-level pivot here. And I think it could, maybe it's got all this London whale stuff behind it, and there's been some shakeup in the executive team. So could be some issues that are finally behind JP Morgan. And like you said, technically it broke back above its 8 and 21 day and 50-day moving averages. So you could see a nice little flag forming over the last 3 days in JP Morgan that could provide some fuel for it to break above this pivot and then potentially challenge those pivot highs. But just another one in this group that I think is helping lead this market higher right now.
And then there's Bank of America, which is holding on to current gains pretty well. It had a good entry point on April 18th. Where might we get another one?
Yeah, it has a similar pattern to a lot of the other banks. It's one that I know Scott has been playing a lot, Scott Redler. Obviously, of the T3 Live team is normally standing in my place. He loves to play Bank of America. It's a lower price stock that people like Meredith Whitney are very bullish on it, thinking get a nice percentage move. And it's, like I said, a similar pattern to a lot of the other ones, back above all of its short-term moving averages. If we go to the chart, you can see all that's in the way now is that pivot from early March. And I think you'll see the banks at least test that pivot, as most of them are above these shorter-term pivots from early April. But the question is, will this be a sector that is going to drag the market higher and continue to show relative strength? And that's something that traders will obviously be paying close attention to.
And let's just mention Goldman, of course, which is also holding on to current gains pretty well and has reclaimed the support of all key moving averages.
You got to mention Goldman, I guess, when you mention the banks, but it really has become one of the weaker ones in the group. It's a very clear downtrend in place if you go to the chart. You see a nice descending channel, and I guess descending channels in general, we like them because they allow us to identify a nice entry point and stop loss level for the trade. So I wouldn't get involved with Goldman Sachs until it breaks this downtrend and breaks out of this descending channel, because of the ones we talked about, it's the only one that's below its 50-day moving average. So like I said, every quarter you sort of hit the reset button about which one's strong in the sector, which ones are weak. And Goldman, after a period of strength from December through mid-February, has actually become one of the laggards in the group, and one that I wouldn't be involved with if I was looking to only buy one or two banks.
All right, well, time for some quick hits here. Let's talk Apple, which had a great day yesterday, climbed over 3% on speculation about the iPhone 5S. So now the question is if this will be part of a bigger move we'll finally see out of Apple.
Yeah, a lot of people attributed that move to speculation about the iPhone 5S, but I think in general, people are just starting to warm to the story of Apple a little bit. You did see weak guidance on the earnings report. You did see margins continue to shrink and things like that, but you also saw them make a little bit of a commitment to a more progressive capital plan with the share buyback, the dividend raise. Those are all things that investors wanted to see, and maybe Apple didn't go far enough in terms of the size of the buyback or the size of the dividend raise, but I think in general it placated some angry shareholders, and I think the potential for new products in the product line to ignite this stock is too much for people to ignore right now. Is that you have basically the core products that are a little bit old and a little bit becoming almost outdated, and people want a bigger iPhone, they want an iWatch, they want an iTV, and if one of those things does get announced, which Tim Cook hinted at in the conference call, I think it really could ignite this stock. If we go to the chart of Apple, you can see technically that it's coming into its 50-day moving average, and it's back above all its short-term moving averages, which has been a somewhat rare occasion for Apple over the last few months since that demise from over $700 a share. But technically, if we can get above this 50-day moving average, it could really ignite a bigger move in this stock. And we have this pivot here from when we last tried to break above the 50-day from late March. So continue to watch Apple. I think in general, Apple is either going to go and leave everyone behind, or it's not going to go at all. So if you do get even a shallow pullback, perhaps into the 8 and 21-day moving average, I think you have to be aggressive with this or risk being left behind. But we'll continue to measure short-term composure. Right now, it's not one that I think a lot of swing traders are eager to put in the drawer, but over the long term, I think Apple is a value here, and I think any new products that come out are really going to ignite the stock and get it back up near that $500 level.
And just to play devil's advocate, what if we don't get an announcement of some new innovative product?
If we don't get an announcement of new innovative products, I think it'll just be stuck in the mud for a while. I think that the share buyback and the dividend raise on that earnings report were sort of a put option that Tim Cook, I was going to say Steve Cook, if only they could mix Steve Cook and Steve Jobs and Tim Cook, but I think he sort of put a put on it at $400 a share, and anything beyond that, I think they'll continue to buy back stock and demonstrate that they believe there's an extreme value in Apple stock around that level. So I don't think we'll get an acceleration below this point if we don't get any new products, but I think the risk reward right now is skewed in favor of the long side for Apple.
All right, we made that a little bit of a long hit, but it's all right, it's Apple. So
Let's
check in on Chipotle, which is looking good. It's flagging at the top of a wide range bar that it put in after beating earnings, and it's holding above all key moving averages. So
yeah, Chipotle is one I haven't really been looking at a lot. Is it had a little bit of a fall from grace, like you saw from a lot of recent momentum darlings. If you look at this weekly chart, it had a huge run here from November 2011 up through the summer of 2012. Didn't have one negative week in that stretch, but then put in a little bit of a king and queen candlestick formation here for all you pure technicians out there, and then had a swift fall from grace. Like I said, $450 a share, down to $250 a share, down to its 200-week moving average where it bounced. But like you said, it's come back on the radar and actually has a nice little setup here as it bounced over 100 points from that $250 level. And like we saw with something like an FSLR, you love to see a stock ignite higher and then put in a tight flag, and that's what you've seen with Chipotle. Is you have the 8-day moving average playing catch up, maybe wait a little bit longer for the 21-day to get a little closer. That rest is healthy for Chipotle, and I think you could get an igniting bar out of this flag to match the inbound move, which could be a nice 20-point move in Chipotle potentially. That would take us back up to this sort of cluster of resistance around the 380, 390 level.
And we should also check in on Amazon, which shed another 2% yesterday after reporting a disappointing quarter last week. And as we talked about yesterday, it could be a potential short if it doesn't hang on to that 200-day.
Yeah, pretty much everything we've talked about in today's morning call has been bullish, but I do think that there are pockets of weakness out there that I think on bounces, on strength, that you could potentially look to short. And it looks like the jig might be up for Amazon here. A lot of times they report earnings, they don't make money. People are really negative on the report, in the media and on Twitter and things like that, but the company ends up trading higher from that report. I think the company struggles to make money, but the promise is so great because of the online e-commerce, because of the cloud infrastructure that they've built, that people look to buy on weakness oftentimes in Amazon. But as you've seen over the last 2 days, people are starting to sour maybe a little bit on that story. As you saw, a very harsh move intraday after earnings, and then yesterday we got more weakness. If we go to the chart, we can see that Amazon is coming into the 200-day moving average, which is going to be a very important support level for the stock. Once it breaks that, you basically have this somewhat insignificant pivot around 240, 242. And then after that, you can see this $220 level come into play really easily. Is when you have these high growth, high PE type names like you saw with Netflix when it traded from $300 down to $50. When you had a stock like Chipotle, like I just talked about, that traded from $450 down to $250. You can see these high growth momentum darlings really implode, for lack of a better word, very quickly if numbers start to go south. And with Amazon, I'll be very wary of it. I definitely wouldn't be blindly looking to buy the dip on it, but the 200-day moving average is going to be a key level that traders should watch. And if we do get a slight bounce, perhaps back up in this little upper level floor, maybe that's something you look to short and balance your book a little bit. Maybe a little pairs trade with tech, a long Apple or a long Google or something like that, and a short Amazon. I think potentially you could generate some alpha off that.
So in summation, what would you say your focus is going to be on today as we head into the last day of April?
I think you got to watch tech. Tech is a place that, like I said, it's not as extended as a lot of other charts, and I think especially Apple, if they can break above that 50-day moving average, could really ignite some strength in tech and the NASDAQ, which has been lagging all the other indices. You have a stock like Microsoft continuing to rock and roll, which we didn't even get into in this one. Google is reemerging again. In general, I think tech is a place that has some room, and as people are looking for places to put their money that's not too overbought, tech could be a popular destination.
All right, thanks so much. That's your morning call for this Tuesday. Happy trading, everyone. Have a great day.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.